Your take on these numbers so far, Helen?
I would say that the manufacturing side of the PMI seems to be holding up reasonably well. We were not expecting a number that is higher than last month, mainly because that the March PMIs usually are subject to more seasonality impact after the Lunar New Year. So historically, it always ticks up. So you shouldn't be taking the full, amount of the upbeat numbers from March as the full amount of improvement in momentum. But in April, always, usually that will slow down a little bit. So actually, we were expecting a 50.2, and the result is slightly better than that. And the beat, I think, is still pretty encouraging. It's consistent with the fact that first quarter data were actually showing more catch-up already on the investment and the industrial side.
Yeah, and if I haven't seen the subcomponents yet, but are you curious to see any specific subcomponents in PMI?
Yes, I would say that on the industrial production side, the production activities would probably be most important to watch. But at the same time, people would be watching for new orders and also exports side. And I would say that if they are holding up reasonably well, then that's probably opening door to actually a strong set of numbers for second quarter. This is because, David, that last year, second quarter has a very low base. And if sequential, which is PMI, is telling us that the growth momentum holds up reasonably okay, in year-on-year terms, this is going to translate into much better year-on-year numbers. So that is going to be, a potential more positive news to support the market.
It seems to be more of a slowing in non-manufacturing. I mean, you mentioned the seasonality that might be leading to this drag, but is there anything more beyond that than you think?
Yeah, the non-manufacturing or service PMI is slightly different. It is not subject to the same amount of seasonality as in the manufacturing PMI. But I would say that there was this very evident dichotomy in the economy where you see a lot of the drives are actually coming from the service in 2023. But this year, that is slowing down a little bit and then more changing gear and turning into the manufacturing side for goods consumption. I think that's actually a good thing. It is also suggested that potentially this is driven by also stronger investment. So by comparison, more resources have been now diverted towards the manufacturing investment side of the things. So that's a potential positive change, and that is in line with our expectation.
There's been a very strong rally in the Chinese bond markets, maybe partly on expectations that the economy or rates continue to fall and the economy perhaps doesn't rebound as quickly. What's the course of travel, direction of travel in the economy? Should we still chase the CGB rally?
Well, I think that particular rally has been thwarted somehow in the past few days.
Yes, yeah.
Not the least because of all the the PBOC's expressions about this is not a QE suggestion, and also the very fact that people were expecting maybe a little bit stronger growth after seeing a bit better numbers. And also yesterday, I think the street talk you probably all saw about the the Politburo meeting coming tonight will be quite important to watch, because if that turns out to be true, which indicates a potential turnaround of property policies, then probably the bond buyers may not necessarily be as bullish, because that may imply a faster growth restoration.
And what will we expect in terms of any sort of property stimulus? Is it something that's more going to be broader? What are you expecting? We've seen home relaxation, restrictions being lifted. Is this something that could be more nationwide? Or maybe even eliminate, property tax. I mean, people are talking about property taxes and the like, but what will you be expecting?
We are keeping our fingers crossed for more policy easing, especially in terms of relaxing those demand restricting policies and more broadly, as you said, on a national basis, right? I think so far we have seen very sporadically, and painstakingly one city after the other. And also, sometimes it may actually just be a very minute change. For example, whether divorcees would be considered eligible right away, right after divorce or 3 years later. So those kind of adjustments in our view are very limited, and we certainly need to see a more aggressive way of relaxing more. And now I think the rumors are that we're seeing more tier 2 cities joining and completely opening up their property eligibility, property demand eligibility requirement. But at the same time, are we going to see more, for example, going to tier 1 cities? That I think it would be key to watch. watch in the near future. Of course, what people are now wondering, and the reason why the property names jumped so much yesterday, was that some of them were hoping that the government is going to turn around and buy up more unsold inventory. If that's the case, then their liquidity may improve right away.
The buy versus build.
Buy versus build, yeah.
That takes us to, what does it mean? How good can growth get if we do get something along that policy prescription on property? You have a 5% target right now, projection. How good can things get, all things considered?
Well, good question. We just upgraded our GDP growth forecast about 2.5 weeks ago, and to currently 5%. So we think that there is a still pretty balanced risk on either side, because I do think that, as you said, probably a more a resolute action on the property side, and also at the same time maybe better funding and more progress on the infrastructure investment side will potentially give us more upside. But at the same time, I think that potentially the risks are also, especially in the second half, if trade protectionist risk is going to revisit and the external demand may wither somewhat. So compared to the upside, I would say the downside is also reasonably large, and therefore I would say that right now 5% is probably where we're comfortably sitting on, and that is the target after all for this year. And there's no need for policymakers to do too much more to impress anyone.
Okay, so you're not expecting further policy easing. I mean, does the Fed factor also become a big sort of factor as well? The fact that they keep delaying these rate cuts, it seems, or at least markets are pricing in that?
You hit the nail exactly on the head, and Yvonne. The thing is that we are expecting more policy easing, but probably less monetary easing, especially by way of, let's say, interest rate cut through one-year LPR compared to otherwise, because we were hoping that the PBOC could have more room to do more things in this year, primarily because that funding cost is still high in China at a time when inflation is really low. So in real terms, that is actually unbelievably high from an Asian context perspective. But the problem is that with the Fed probably postponing their potential cut all the way to December, that's our house view, maybe at most a 25 basis point of a cut in December, and also with the 25% probability that they do not cut at all, then that implies probably not only for PBOC in general, central banks in Asia would have less room for easing because of the concerns on the exchange rate. Yeah. So far, I think the yen has depreciated the most. None of the other Asian currencies has followed as much. Yeah. But the risks are that if they go further, how much more depreciation we shall see in this region.
There was talk, I think about two weeks back, that maybe the window for the PBOC to reduce rates would be when the ECB does, June or July. Let's say they do that, and let's say the Fed moves 6 months down the road in December. How much damage do you think that's going to do to the currency, the Chinese currency?
Well, I don't necessarily think that cutting the interest rate would be, just introducing more externalities on the negative side, in the sense that it also lowers the domestic funding cost, and then that's probably going to buy a little bit more time and get the domestic demand boosted a bit better. But if they actually look for that opportunity for ECB to do something and then make a move on the back of that, I would say that would probably be a signal not only for, China, but also for the whole FX market in Asia, because effectively not only North Asia, look at Korea, Taiwan, and but also the entire Southeast Asia. I think everybody is actually watching the anchoring impact from the renminbi. But if renminbi actually goes much lower from the current level, that's potentially a signal for others to depreciate a bit more, a bit less reluctantly, let's say.
And, sorry, very quickly. This mini devaluation conversation, is that nonsense in your view?
You mean a one-off?
Yeah. Or? Well, whatever definition you think.
Well, but it could be in different ways, right? If it is a slow but gradual depreciation, I think it's justifiable from RER or NER perspective. But if it is a one-off, I think that is much more difficult to execute.